most important indicators for traders is the moving average convergence divergence, or MACD. It gives you buy and sell signals that take into account whether a trend is accelerating or not. Imagine you found a new uptrend on your chart, but you aren't sure if it will keep on rising. Well, checking the MACD can tell you if the trend is slowing down and fizzling out, or if the trend is accelerating and offering a good opportunity to open along. Mostly, the MACD should be used to tell you about the strength and acceleration of a price move, but it can also provide other details like the direction of the trend itself. For those interested in the math, the daily MACD line is created by taking the difference between the 12 daily EMA and the 26 daily EMA. As a lagging indicator, it may take a couple of days to respond to trend changes, but using the MACD along with your support and resistance and other trend lines can really improve the effectiveness of your calls by sussing out the direction and degree of acceleration of a trend. Drawn along with the MACD line is a 9-day MACD EMA line, which is called the signal line. It acts as the baseline that we compare the MACD against in order to identify tradable signals. When you subtract the signal line from the MACD line, you'll get a set of numbers that oscillates between positive and negative numbers. When those values are charted on a histogram, they help traders determine how strongly bullish or bearish the price action's momentum is. For example, when the histogram is growing larger in the positive direction, it shows an accelerating or strong upwards price momentum. The opposite is true when the histogram is negative, so that as the histogram trends further into the negative territory, you know that you have an accelerating downtrend. By identifying the rate of change in a trend, you can determine if it is expected to continue. Now that we have an understanding of the components of the MACD chart, let's go deeper into interpreting this chart and picking up on indicators that can help us make successful trades. Divergence indicators form where two lines move away from each other in opposite directions. One of the trend lines is usually the price, and the other trend line can be any oscillator such as the MACD line. The fact that the two signal lines have fallen out of agreement creates divergence signals that may indicate an incoming trend reversal. When looking at MACD divergence, there are 4 scenarios that may come up: bullish, bearish, and 2 scenarios with no divergence at all. To test for divergence signals, you first draw a line segment between a pair of higher highs or a pair of lower lows on the price chart. You then do the same on the MACD oscillator, which will also have a pair of highs or lows on the same time frame. Here you can see examples of bullish and bearish divergence as it appears on a price chart. An easy way to think of MACD bullish divergence is as a momentum indicator. Simply put, if the price isn't falling as quickly as it was before, then it might spell some good news for future prices. Let's take a quick look at example in our chart. This shows a lower low on the price chart paired with a higher low on the MACD. This is an example of a bullish MACD divergence signal that could precede a breakout. Remember, whenever the MACD is below 0, you're in a downtrend, but the strength of that downtrend is determined by how far away the MACD is from 0. Since the MACD is getting closer to 0, i.e. higher low, the downward trend is weakening, which could hint at a pause or even reversal of the downtrend. You won't want to place any trades because of this indicator in a vacuum. Instead, combine hints from your MACD divergence signals with a couple of other indicators to see if they all agree. And if they do, then you may decide to open up a position. Taking a look at the table where we can see that example 2 shows a higher high on the price chart paired with a lower high on the MACD. Because they disagree with each other, we know there is a divergence signal flashing. So, what does it suggest if, despite price still being on the rise, the trend is weakening? It raises my eyebrow now because it tells me there's a bearish divergence signal flashing. So, I wonder whether the trend would simply slow down, or whether a more extreme trend reversal is incoming. After all, the rate of growth slowing could logically mean that an incoming pause or reversal is on the horizon. Again, we shouldn't look at MACD divergence signals in a vacuum. Instead, this is an opportunity to check your other indicators and carefully watch the progress of the trend. If you find confirmation within your other indicators, then any open long position is becoming riskier, and opening a new long is certainly less enticing. For those who may already be in an active trade, a weakening trend also hints that it might be time to take profits. With the moving average convergence divergence, the primary buy sign to look for is when the MACD line crosses over the signal line. When you see the MACD line cross above the signal line and the MACD and signal line is below zero, then that indicates a move from a bearish to a bullish sentiment. When the MACD line crosses above the signal line and both are above zero, that will generally mean that there was a short-term pullback and sentiment is moving back up in a positive direction. The zero line crossover, aka center line crossover, happens when the MACD line crosses the zero line and becomes either positive or negative. If the MACD line crosses over the center line and becomes positive, it indicates a bullish crossover. On the other hand, when the MACD line crosses the center line and becomes negative, it is a bearish signal. This is a slower indicator, but is less prone to false reversals. Be aware that when the market is very volatile, MACD line will cross back and forth over their signal line and the center line, giving less reliable signals. This is why MACD is often combined with other indicators to help determine false signals. The moving average convergence divergence, or MACD, is a powerful lagging indicator for trading. It gives you buy and sell signals that take into account whether a trend is accelerating or not. The MACD is susceptible to many false signals depending on a number of factors. First, if your time frame is too short, you'll experience too many divergences that make the indicator useless. Additionally, if the market is very volatile or if you have extreme price movement, you may experience divergences that are false indicators as well. Longer time frames, like the daily chart, are better suited for MACD divergence analysis, as they will yield fewer yet more accurate divergence signals. A MACD divergence signal is even stronger if it's paired with a crossover signal. However, since the MACD is a trailing indicator, using a daily chart can cause a slower realization that the market has changed. Because of this, you can use a shorter time frame MACD, such as say a 4-hour or 2-hour time frame, to identify the divergence quicker, but it is still recommended to use other indicators along the way. It's important to keep in mind that no individual signal can be relied on in a vacuum. This is especially true of MACD divergence signals. You always want to make sure you have a strong confirmation from multiple signals before you put your money on the line. Many traders will pair MACD tool with another analysis method, including leveraging price action for their analysis. CryptoMonk's content is not financial, tax, or other advice. Never transact based on it. Do your own research and consult certified advisors. Investing is risky and you could lose everything.